Good afternoon. Thank you very much, and thank you for the invitation to speak here today. It's truly a great pleasure to be here. I read the agenda on the way up for the next 2 days, and it's an absolutely fascinating agenda and a really impressive roster of speakers. Indeed, I've concluded that sandwiching this session between Tim Berners-Lee and the EU referendum debate is a way of trying to ensure that you can actually tell your employers that this really was work and not just fun. Moving on from Tim Berners-Lee and away from revolutionising the way the world communicates and back to the rather more mundane world of regulation, I want to talk about two things this afternoon. One is, of course, our market study and where we are on that. But to put that into context, I do want to mention the importance of innovation in driving change and competition in this as well as other industries. As you're all very well aware, and as the conference title suggests, we're currently operating in a time of great change and significant uncertainty about the future. 2016 so far has seen a continuation of the ultra-low nominal returns, a slowdown in the global economy, and increases in market volatility. And alongside those economic challenges, the pensions industry is also having to adapt to a changing landscape. In legal and regulatory terms, of course, but also, and possibly more importantly, in terms of the demographics of our population. How the industry responds to those challenges is a complex question, and I doubt that we can ever definitively solve the task which this year's conference title suggests, which is creating certainty out of uncertainty. But nor do I believe that there is any cause for counsel for despair. The UK's financial services sector has dealt with significant societal and economic challenges before. Each time, it's evolved or reinvented itself to meet those challenges. New players have come onto the market, and established ones have changed the way they do things. Exactly that same process is required today. And there is no more important area, frankly, to apply that than in managing the fresh challenges and seizing the new opportunities presented by the UK's ageing population. Many of the impacts of this population and the drivers behind them are very well documented. We all understand the transformational shift there has been from DB to DC pension savings. We all understand there are broader questions around the general public's expectations of what they might do with their pension savings in the future. We can see the shift to a need for increased personal responsibility for your own financial planning. And of course, we all understand that it is difficult to make the retirement mathematics work in a society that is ageing quickly and saving less while living longer. The challenge for those providing long-term savings, and pensions in particular, is that the core of your business is about trying to anticipate the future. And that's obviously a notoriously difficult task in financial services. Nobody, as the old stock trader adage goes, rings a bell to tell you that you're at the top of the market. But it's not just market uncertainty you have to manage, but also wider issues too. When today's 65-year-olds were born, the average life expectancy in the UK was 65. So who would have been predicted that today they would be living to an average age of 86? Who would have predicted 15 years ago that the Bank of England base rate would have been at 0.5% for 7 years? Who indeed would have predicted the explosion of the internet? Yet all of those things have come to pass, and it's critical that as an industry, you not only respond to those challenges, but also do your part, if not in predicting, at least in making sure you are ready to anticipate and adapt to the challenges of the future. After all, one of the things we do know for sure is that if pensions issues aren't dealt with until after their consequences have materialised, it will already be too late to manage them. And that's one of the reasons why we at the FCA last month published a discussion paper on the UK's ageing population, pulling together a number of external perspectives to highlight the challenges, risks and opportunities this demographic change presents. Now, of course, it's not our job to solve all of the challenges of an ageing population, but we do believe that as a regulator we have a role to play in triggering that debate, and we very much encourage you all to contribute to the discussion. And of course, a critical question there is whether the market in its current form can meet the needs of that changing population. And I think it's obvious that solutions here will require creativity as well as innovation and increased competition. The PLSA published a paper in January which stated that there was now no more normal. Change and disruption, to preempt a later session this afternoon, are already part of our professional lives, and it is critical that the industry and regulators work together to ensure that such change and disruption, while heralding the future, also learns from the lessons of the past and is designed to deliver good outcomes for consumers and society. Now, the indications are that financial services companies are bringing through new ideas to support savers. We've seen the launch of a number of new non-advised platforms in the retail market, and you have eye-catching changes like blockchain with its potential to automate back-office functions in the industry. But I would argue that less flashy advances are also just as important. Innovation emphatically does not just mean tech-led change, new apps and gadgets of the types loved by early adopters and teenagers. Innovation in our mind is much broader in definition and can pull in all sorts of useful advances, including areas like the use of behavioural economics to consider how products will work in the real world with real people rather than in a stylised one where we all make rational economic choices after analysing all the options thoroughly. And we've seen firms starting to do that, to build that into their design process, to look at how to address behavioural challenges relating to retirement planning. Innovation in the pensions industry and asset management, whether it's a headline-grabbing sort or not, is of enormous financial significance to the nation's savers. And it does seem inevitable that we will see more change, with asset managers and others developing new decumulation products and services, as well as more disintermediation and more automation of advice. So some change will inevitably just happen, regardless of what we do. But I don't say that to play down in any way the importance of policymakers such as the FCA in creating a supportive environment to allow that innovation to happen. Now, it's pretty easy to criticise the public sector for our perceived lack of entrepreneurial endeavour, and it's probably fair to say that actually most regulators are not inherently great risk takers. But the fact is that most of the world's most pioneering and ubiquitous innovations, things like GPS, touchscreens, voice activation, do owe much of their development success to the official sector, as do a number of the world's biggest and most respected firms. So regulators, along with governments and others, do have a positive role to play in fostering useful disruption. And the FCA is somewhat unusual among financial regulators in that we have a competition mandate that directly supports this objective. And one of the key ways we have sought to achieve this is by establishing an innovation hub, a unit within the FCA that is specifically geared towards working with large and small innovative businesses. Essentially, the hub does two things. One is to provide direct support to firms that are exploring innovations. In the past, those firms often struggled with how to start a conversation with the regulator. The hub provides an avenue with an approach tailored for those firms. And the fact is that some of the new business models they have may not fit easily into regulations designed around the last generation. Through the hub, we can advise individual firms on navigating the regulatory framework and also find out which aspects of it we might want to review. The criteria for FCA support through the hub include that the firm has an innovative idea, has done some work already, including some regulatory research, has a genuine need for support, and lastly is going to provide consumer benefit. As one of my colleagues put it, we're not here to support innovative tax planning. The second strand of work in the hub is about us as a regulator listening to the industry. We want to hear if innovation is being held back by regulatory barriers and ensure that our frameworks remain fit for purpose. I'm delighted to say that out of the first wave of firms the hub has supported, we've already seen 18 new firms authorised and another 21 going through our process. That's about a 30% conversion rate of the firms that initially contacted us, and it includes a number of investment firms and insurance intermediaries. So progress is being made, both in absolute terms and indeed relative to other areas of the world. Ernst & Young last month described London as the ultimate capital for financial technology. And we all know that imitation is the sincerest form of flattery, and we've seen lots of imitation of what we're doing in other jurisdictions. So we can't rest on our laurels, and we're working on developing our reputation in this space and looking at ways we can also support more players and more people onto the pitch. And one area that we are exploring, and which has already attracted significant interest, is the feasibility of what's called a regulatory sandbox. What do we mean by that? Effectively, it's a safe space in which new entrants and established players alike can experiment with innovative products, services, business models and delivery channels without having to immediately incur all of the normal regulatory consequences. The reason we think this is worth doing is because we think that there is a benefit for the general public if we can get useful innovation to market more quickly, in much the same way as the pharmaceutical industry has worked with regulators over the years to try and bring treatments to patients more quickly. So we'll have a range of practical options open to firms around how we will take them through the sandbox. And alongside this, it's important to say there will also be safeguards for consumers who are involved in that testing. So there will unequivocally be no lowering of the protection afforded to consumers. And the terms of reference for any testing through the sandbox will also be agreed between firms and the FCA prior to commencement to be clear everyone knows the framework they're operating in. Now, these innovations are significant steps forward for financial services and their customers. And it's easy to see the practical potential in areas like advice, which obviously was thrown into sharp relief as a result of the pensions freedoms. And the Financial Advice Market Review, which I co-chair and which is due to be published shortly, will explore options and potential remedies across financial services here. But given the social and economic challenges involved in providing for the UK's ageing population, we do hope that those of you supplying these services to the pensions industry will also make full and enthusiastic use of the Innovation Hub and the Sandbox when it's up and running later this year. But we are, of course, acutely aware that helping new players, products and services onto the pitch is only one part of the solution, albeit an important one. We also have a very powerful role to play as the regulator in ensuring that competition plays out efficiently and in the interests of consumers between existing players as well. And this is, of course, particularly important as it relates to today's pensions and asset management industry, because it drives ultimately how value is driven to end investors. And that is why the FCA has announced and commenced our market study into asset management. Now, I think it's important to say, first of all, that asset management is clearly one of the UK's success stories. With 6.7 trillion of assets under management, including 2.6 trillion from overseas. Moreover, it's nothing if not a vibrant sector, with some 1,900 firms serving millions of domestic and international end users. It could be said to be a true jewel in the UK's service export crown. And some have asked, in those circumstances, why do we need a market study at all? Isn't the number of firms evidence enough of effective competition? The answer to that, in our view, is very clearly no. We know that financial services are far too complex to make such simple inferences about effective competition just from the numbers. And it's also worth noting that those huge sums that I mentioned under management mean that very small changes to the effectiveness of the market can have big impacts for consumers. The IMA has estimated that every basis point saving from improved efficiencies could translate into 264 million in client returns each year. Over a 30-year period, you can compound that up to some 37.5 billion. So there is no room or reason for complacency. With scale and importance comes responsibility and also regulatory scrutiny. And this is particularly the case today, given that the recent policy changes we've seen in pensions will see more consumers needing to engage more with asset management firms. And as I've already said, given that those same consumers are likely to be living longer and potentially saving less than their parents' generation, it is of enormous consequence to make sure that they receive the maximum bang for their buck. And the scope of our market study reflects this. The scope was derived from specific discussions with investors, including members of the PLSA, about value for money and whether it was possible to judge it, and the ability of investors to monitor the advice, products and services being purchased along the value chain. Questions were also raised with us about the role of investment consultants and the potential conflicts of interest in the provision of advice and asset management services. So you should be in no doubt that this is a serious and wide-ranging exercise. As many of you will know, we invited feedback on our draft terms of reference last November when we launched the study, and we've had the responses to that feedback. And I have to say that the general response has been pretty supportive. Most comments do seem to agree that we are focusing on the right area. And as our study continues, we will want to continue to engage closely with the industry and others, and there are a number of important next steps underway. Among them, the Institutional Investor Survey, on which we've been very grateful for the PLSA's engagement with the FCA, both on design and distribution. The point of that survey is to try and help us to be part of what helps us paint a sophisticated picture of how purchasers of asset management services view the market. Are there opportunities to improve the outcomes for you and your clients? What's important to your investors? And is the industry meeting those needs? Now, if you're sitting there thinking that there were practical measures that could be taken by way of improvement or specific parts of the industry where you think you may not be getting value for money, the FCA team want to hear them. And that can be through the survey, through the PLSA, or direct to us. And we have, of course, extended the same offer to others who are involved in our research work. This is a broad church. We've sent information requests to asset managers, to investment consultants and platform providers. We're engaging with ancillary service providers, smaller firms, consumer groups and trustee representatives. And firms that have been participating in our initial information request will be seeing more of us over the next few months. And alongside this, we'll also be conducting a comprehensive programme of international comparison work, as well as econometric analysis into the factors that drive fund flows and other decisions. We expect to publish an interim report later this year. One final point it's worth repeating about the market study is that we are not approaching it with any preconceived conclusions. It's being conducted because, and only because, it is an imperative for the general public, the wider economy, and for asset managers that there is effective competition and innovation in this industry. And that must mean that firms need to have sufficient incentives to identify and satisfy client demands as efficiently as possible, and to constantly seek out business from clients who are currently using their rivals' services. By way of conclusion, I would just like to say that we have seen important signs of progress here. Ahead of the implementation of MiFID II and following supervisory work by the FCA, a number of asset management firms have already made big changes to the way they purchase third-party research, which is resulting in real cost savings for their clients. Several asset managers have gone further still and stopped paying for research with dealing commissions altogether. And we've seen new entrants, particularly in the passive investment space, come in with some pretty aggressive pricing and shaking things up a bit. So we see firms competing on value. And as I've already mentioned, we are seeing technology-driven innovation in the sector as well. So the FCA has a vital responsibility to ensure that those new entrants are able to come onto the pitch. And more importantly, to make sure that they have an incentive to do so, knowing that they will be able to compete fairly and drive innovation and change in the interests of consumers. And our market study is an important part of ensuring that that is the case, which we believe is in the interests of the FCA, of the industry, and most of all, of the end user of all of your services. And we very much look forward to working with you all to help us deliver that vision. Thank you.
Thank you, Tracey. I'd like to turn now to each of our panellists in turn, starting, if I may, with Andrew Stevens.
Good afternoon. It's good to be here. Thanks for having me. I found it interesting to hear Tracey's remarks on competition in general and the market study in particular. I don't think anyone can argue against the idea of effective competition being a spur to innovation, to new solutions that can help solve the pensions problem. And to be fair, it is a problem that needs constant attention. No one in this room needs reminding that over the last 10 years, aggregate funding levels have worsened. Looking at the PPF data, the aggregate deficit now stands at about £300 billion. And that's after £250 billion worth of contributions over the past decade. What's worse is that the situation comes against a relatively supportive market backdrop. Until the recent market correction, the equities had been enjoying their third longest bull run on record. The 30-year-long bond bull market continues to this day, and all in an environment of relatively low volatility across all markets. My point is this: it seems that persistent deficits are a result of poor risk management as much as poor asset management, where insufficient hedging and not managing both sides of the balance sheet in conjunction has been a major contributory factor. The question we should all be asking, and I guess that's why we're here, is what, if anything, needs to change in order for us to stand a better chance of success in the future? And while my role today is not to depress you, the market environment on a forward-looking basis looks nowhere near as benign. Our own recent equity forecasts, for example, have equities delivering somewhere around 5% or less per annum over the next 5 years. So where to from here? One more piece of industry context is that the landscape continues to change at pace. Tracey touched on this. But the days where roles were clearly delineated, where responsibilities were cleanly separated, are largely over. Today we have advisory firms that manage money, we have asset management firms that provide advice, and we have professional trustees that are increasingly influential on all pension matters. On the face of it, these additional players should be providing the additional competition that Tracey refers to and creating the disruptive forces that can spur innovation. On the other hand, the increased complexity and the potential conflicts may also make it more difficult for clients to make informed choices and to evaluate whether they are getting value for money. And it is on this point of value for money that I'd like to focus. How does a trustee board determine in which areas they should be deriving the most value, and then determine whether they are in fact getting value in that particular area? If we start with the end in mind, i.e. ensuring that benefits get paid, it might be worthwhile determining which are the most likely decisions that are going to influence the success or otherwise of getting to that goal. For example, getting the asset allocation call right has got to be the most important decision that trustees make, followed some way after by the implementation decisions, timing, active or passive management, or indeed which manager to use. With that in mind, we can ask some leading questions. Are trustees spending as much time on asset allocation decisions as they are on manager selection? How thoroughly, how consistently, how frequently are trustees evaluating their advisors and the advice they're giving? And as providers, how easy do we make it for our clients to assess us? How transparent are we? I think these are just some of the questions that we need to answer if we're going to have a better chance of making well-informed and therefore better decisions. Which brings us back to competition. As I said at the beginning, it's hard to argue against effective competition being good for trustees and being good for the industry. But in my mind, 3 conditions need to be met in order for competition to be effective. The first one's most obvious. You need choice. There needs to be more than one, and preferably a lot more than one provider for each component of the value chain. The second is that those choices need to be differentiated. Easy there, Robert. They need to be differentiated. In fact, there needs to be real choice for customers to make. And the third, and the one that I think is less often spoken about, is the willingness of clients to choose, to make change. Without the ability and the willingness to do something different, to make use of the innovation, to listen to different ideas, competition cannot be effective. And in my view, inertia is one of the things that has got us into the situation that we're in. Now, I'm sure many of you in the room are thinking to themselves, they're fully aware of the levers that they have to pull, and they will pull them if necessary. If that's true, I'd ask in return, how do we find ourselves in a situation where the average hedge ratio is 40%, where most pension schemes are able to liquidate huge swathes of their portfolio within a week or a month, thereby ignoring attractive illiquidity premia, where advisor appointments seem, if not permanent, extremely long-term, and where clients extend advisory mandates into asset management mandates without open tender? As we have seen over the last 10 years, focusing on the wrong things and inertia can be dangerous. And in the current environment with funding levels where they are, I think it is important to ask whether continuing to do the same things can be relied upon to give a different outcome.
Andrew, thank you very much. I'll hand over now to Robert.
Thank you very much. Thank you. Good afternoon. Thank you for asking me to speak this afternoon. I should firstly start by saying we very much welcome the FCA study. Many of its aims, in fact, reflect our long-held views of how the industry should evolve and change to better serve asset owner interests and fundamentally those of the end investor. And the focus on costs, incentives and alignment, I think, are absolutely correct. I'd like to make some comments that fall into 5 categories. Sorry, as normal, I've not only broken the stage, I've broken the mic, which is great. So those of you who know me, watch out for the third thing. So I want to make some comments in 5, very briefly, in 5 areas. Firstly, the outlook for returns, which I'll pick up a point that Andrew made. Secondly, on the structure of the industry and about conflicts. Thirdly, around costs. Fourthly, around innovation. And then finally, around complexity, competition, and governance. So I think it is fair to say, and I agree, that investors themselves are in a difficult position, not just pension funds. Investors, full stop, have an issue. They have an issue with low returns. And indeed, if you think Andrew was pessimistic, our 3-year numbers for equities look for about 3% nominal, which is about 1% real on a 5-year horizon. So I think investors have this issue. And what's interesting is that we surveyed a group of global investors relatively recently, and their targets, when we asked them what their targets were for CPI plus 4, so 4 real. When we looked at our assumptions at the time, you got to about CPI plus 2, so there was clearly a difference, and many investors are looking to make that up through added value activities, etc., etc. The problem with that is there's a fallacy of composition problem. Not everybody can do it. So if you think that returns are low and risks are elevated to the downside, which I believe, I think many investors are going to be disappointed. As a result, and this echoes a point that Graham made in his introduction, as a result, investors need to think about pulling every lever they have available to them in order to improve returns. That's costs, that's risk management, that's structure, and so on and so forth. I think investors are in a very difficult position. If we look at the industry itself is actually quite fundamentally simple, or it should be simple. We have end investors that desire capital, and we have at the other end of the chain savers that desire a place to put those savings. So we need an effective mechanism or transfer mechanism for that to work. However, the decision chain itself is full of agents. We have broker-dealers, we have asset managers, we have consultants, we have retail financial advisors, and so on and so forth. All of those people are agents. None of them are principals. They're all agents, and they all make or influence investment decisions, and as a result are all subject to potential conflicts of interest. So that needs to be managed. For those of you that have listened to me over the years, I've, for many years, made comments about the level of cost in the industry. Over the last 5 years, there's been a general groundswell accepting that the level of costs in the food chain are bluntly too high, despite the fact that the marketplace, I would argue, is relatively competitive. There are relatively low barriers to entry in many of the areas that we operate in. However, there are also structural problems or structural issues within the industry. Information in the industry is very asymmetric. The sellers of the information should have a clear idea about where the sellers of the product should have a clear idea about those products. The buyers of those products, less so. So as a result, they hire agents like consultants and other people to help them. The buyers of asset management services are also quite fragmented, so they're quite weak buyers of those services. So again, some of the areas that we've been thinking around, if you look at other industries around the world, how do you deal with some of those problems? Well, aggregation potentially is one of the ways of dealing with that, and you've seen that in the Australian market, for example. So again, and we also have an industry where fees are based on asset values, and also it's not like a normal industry in the sense that the outcomes are very uncertain. You have an uncertain set of outcomes. Briefly turning now to innovation, there's been significant innovation over the years, some good, some bad, although, again, to echo a point that Andrew's made, I think it's difficult to see the prevalence of relative return products over and above a focus on risk management or asset allocation decisions, and that, I think, needs looking at. Combined with innovation is also a degree of complexity, and if I think back to when I first started in the industry over 30 years ago, The industry has got more complex, capital markets have got more complex, and broadly speaking, investment products have got more complex. That's potentially good for sellers, not necessarily good for buyers. With complexity and alternative investments, so on and so forth, you typically get very high fee levels. Now, there's been some innovation to try and disintermediate some of the complexity and some of the cost in terms of so-called smart betas or alternative betas, where products that were being charged with very high fees, alpha fees, are being charged at lower fee levels, which has helped. The final point I want to make is around competition and governance. Over the years, competition has been increasingly severe. Competition for resources, for returns, for talent continue to go up. It's relentlessly increased, complexity has gone up, and as a result, there's been a desire or a need for greater governance, greater management resources for investors to deal with this complexity. I remember speaking at a conference about 10 years ago, and the message was, simplify or raise your game. Many investors, particularly large investors, have indeed raised their game. They've raised their game by employing significant internal teams, which is changing the structure of the industry, particularly for the large schemes, and many investors have simplified and taken costs out of their structures. Nevertheless, I suspect there are still significant numbers that have relatively complex arrangements and not necessarily the equivalent governance to deal with that. So I think in conclusion, given the current environment and the issues that are faced by not only pension schemes but all investors, I think now more than ever we need to make progress in all of the areas that we've been discussing. Thank you.
Robert, thank you. And finally, I'd like to introduce Chris.
Thank you. Is my mic working?
Yes.
Yeah.
Excellent. I'm not very good with my hands. So I'd like to welcome your speech and your intervention, Tracey. I'd like to endorse a lot of what the previous speakers have said. But I, for one, am filled with joy at the prospect that you're really saying to us, I'm from the FCA and I'm here to help you. I think that's wonderful. I have been here before, I guess. I mean, it feels like 13, 14 years ago, I was involved with an FSA review into transaction costs, which is just a smaller part of the whole thing. And at the time, I was pretty green then, but I was really thrilled and amazed that people were actually trying to help me and my scheme members. I hadn't realized that you kind of existed to do that, but I was very pleased. And I think the solution that came out then was the best that could be done at the time. It really advocated much greater transparency and putting the tools in the hands of trustees, really, to be able to examine the costs they were paying. And transparency is always helpful, but it's not necessarily sufficient. It does depend on the resources which the people pulling the levers have. And I'd continue to argue, a bit the same as you did, Robert, that actually end investors or trustees or whoever administers on behalf of end investors, they have relatively few resources at their disposal. Consultants, I would argue, have a few more, and asset managers have a lot more, I would argue. And the business models are changing, and so these relative resourcing points are shifting around a bit, but nevertheless, that's the gradient. And I suppose I would say that from those to whom much is given, much should be expected. So kind of you're the solution, Andrew. You're the people. Your part of the investment chain is the part that we're looking to, I guess, to really help us to get the best deal through the investment chain. I was part of another review 4 years ago that was run by Professor John Kay, and that was looking into short-termism in the UK equity market, but inevitably we end up covering a lot of the same ground from a different angle, and he very much focused on this investment chain that you mentioned, Robert, and the fact that really markets do only exist in order to serve the people at either end of the chain, the end investors and the companies needing capital, if they need capital. And the rest of us are all agents. And I'd actually include myself in that as well, Robert. You were kind enough to omit me from the list. But I should definitely be in there. And John Kay did observe that this chain appears to operate for the benefits of all the agents in the middle rather than for the people at the end. And how can we fix that? Well, we're still trying. I suppose I would say it's taken us 30, 40 years probably to reach this, this market situation. I'm hoping you can help us not take 30 or 40 years to fix it, Tracey, but I don't think the fix will be quick because, I mean, it's a complex adaptive system. You know, it's nobody's fault, but therefore it's also everybody's fault that things are the way they are. So we came up with a few proposals in the K review, and one of them was to ask the Law Commission to look into fiduciary duty and to see whether there was any possibility of spreading that further down the investment chain. I mean, I think both of your kinds of organisations do feel a sense of fiduciary duty to do their best for their clients, but further down the chain it's much more about the contract. And the answer that came back from the Law Commission was, well, it's all about the contract. And they went on to look at something else again, which wasn't quite what we had in mind. But if there was a way of actually trying to ensure that all participants in the chain were trying to do their best for the end investor, and I don't mean in a micro sense of giving best execution this second, I mean in a sense of looking after their interests over a longer period, I think we might have a more balanced market. But as I've said, I do think that the fund managers, and this is something else that Kay said, are the solution. You know, that's where the pools of assets are, that's where the resources are. And frankly, most trustees in the room are probably looking to their asset managers to be their guardians in the market. And I think in general, there's a lot of good work that's done. But the asset management industry, as you've already alluded to, Robert, I mean, there's quite a lot of it still focused on competing for alpha, I guess, competing using alpha, I suppose. A certain amount of closet indexing, which actually regulation probably assists because there is a need for asset management firms to show that they have stable businesses, which tends to want to take less risk with your client's money. And atomized portfolios, we're all massively over-diversified, and that means we can't really join up engagement with companies and portfolio decisions in an effective way. Now, in our own scheme, Rail, we recognise that we need to change the way we did things, and it was a response to this low-return environment. We did kind of do the Dave Brailsford cycling 101% kind of thing. You know, what things can we change a bit that might make things better? And so we did simplify our external manager arrangements, but we still partner with a lot of fund managers and will continue to do so where there's a value-added relationship for both sides. And we did look really quite forensically at our costs. And whereas I said transparency isn't necessarily a panacea, the opposite of transparency is definitely a problem. And when we looked at the fees that we apparently paid away in fund management that we disclosed in our accounts, and then we really drilled into the pooled vehicles that we used to invest, primarily in private markets, not exclusively private markets, hedge funds, etc., we found that if we added those up and dug as deeply as we could to find them all, the total was actually about 4 times what we thought it was. So we actually employ someone full-time on our staff now just to keep digging and seeing what else we can come up with. And we think we've now got it so it's only about 3 times what we thought it was. But that's, you know, it's probably still a lot. Sometimes the market does need a shove to get the pendulum moving back in the right direction. I'm hoping that's something you can supply. And by analogy, in the DC market, the cap on charges, which was first introduced by the Pensions Quality Mark, by the way, but taken on by government, has changed the landscape in terms of what savers in that market have to be charged. So I'm not saying I want more regulation, but I think there are things that you can do to help us, Tracey.
Chris, thank you. Plenty for the audience to chew over there, I suspect. While you're thinking of your questions, I'm going to start off with one, if I may.